Hey everybody, Preston Brent here with our weekly roundup for the trading week ending July 29th, 2016. So this will round out the month of July as we move into August early next week on Monday. What I've got on the screen here is a whole lot of lines, but it's the E-mini S&P 500 futures. And what I wanted to do is just showcase a couple of things. So let me just take everything off the screen here and keep it very simple. We're clearly in an up mode, all right, or in a bullish mode here. Now, I had called about 3 weeks ago when we were towards the lows down here at this key pivot here around 1980. Okay, I had said that the market right around this area right here, I had said the market is probably once we cleared the 200 EMA, the target that I gave was around 2200. Okay, and then I was just using a combination of Gann and Fibonacci extensions to come up with this calculation. Now we had set at 2134, which was our all-time highs for over 400 days. And I've read all the statistics that say if it takes more than that long to break the highs, then when you do break the highs 6 to 8 months later, the markets are up 15% from there. And statistics are good, but they're just that, guys. They're just statistics. Anything can happen that can be a trigger event that can move the markets up or down. You can also see we're in an Elliott wave 3, 4, 5 here, 5 being the traditional end of an Elliott wave move. You can see my system has put a little small 5 up here that said we could even get up to the roughly, let's call it the 2285 area. My initial shot was at 2200. We've been in a very, very tight range, really less than about 20 points for more than 8 trading days. If I were to count these out, this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So 12 trading days, we've been in a very tight range. Now, we haven't been in a range like this tight, going back over a year. But when we do see a tightness like this with a market that just wants to climb higher, the odds favor a break to the upside. Okay, and that would put me at our 2200 target, which is what I was calling when the markets were down around 2020. All right, so I've got our members really looking at it that way, and I know a lot of people are kicking and screaming and hating this bull market, but again, you trade what you see, not what you feel or think, and that's kind of what we're sitting here. Now, if we break to the downside right here, then the odds do favor a test at 2134, our former all-time highs. That will be just the most logical place for it to come to, and that is not very far from the current price. Okay, there are no divergences to speak of down here either, so this is a valid strong up move. I'm sure a lot of you have heard the saying Tina, right, in the markets, and that suggests there is no alternative. In search of yield, money is coming in from Japan, and it's coming in from Europe, and it's coming into our equity market, and it's coming into our bond market. All right, bonds were on fire today. Now the GDP came out and they were not good at all. First pass of Q2 GDP numbers, the expectation was around 2.6%. I think it came in at like, what, 1.2 or something like that. I wasn't watching very closely, but just really poor. Yet the markets, the E-mini was up 6.25 points. The SPX, the cash index, was only up 3.5 points. But the winner for the week really is Nasdaq. And it's not, we're seeing Nasdaq catch up with the rest of the indexes. I'll talk about that in 1 second. But the dollar is down, bonds is up. That's traditional situation where the markets do not believe Aunt B, that would be Fed Chairman, U.S. Fed Chairman Janet Yellen, is going to rate or hike any rates anytime soon. So we're still in that bad economic data is good for price kind of environment, right? Bad numbers, a bad print. I remember when if we had missed a GDP number like we did this morning, the markets would be off a minimum of 20 points, maybe 30 points. Here, we actually finished up. The initial reaction was down, but there's just too much money coming in from offshore into the game here. And generally when you get up at these levels here, the rat brain trader, that would be the common retail trader, is last to come in. A lot of big institutions are very wary of coming in long here. We are seeing longs in the risk off sectors, especially utilities, the XLU sector, and some of the key utilities stocks or equities trade like bonds. So we're seeing money flowing there. We're seeing money flow into Staples and a few others. We have a couple of good stocks that are really fine-tuned in that area, and it works out really well. But we're in this very tight range, as you can see by this purple box that I put this thing into, right? And if we take it out to a weekly chart, okay, and we really step back, you can see here, this is the high point from last year, and on a weekly chart, it doesn't look like much, does it? We've got the 3-leg, a 4-leg, and a 5-leg Elliott wave. Now, keep in mind that we've got a 3-4-5 on the weekly, we got a 3-4-5 on the daily, we got a 3-4-5 on the 2-hour. So this truly is, I believe, kind of the last gasp before we get a wider chop and a little bit more of a pullback. I do not think the pullback is going to be very strong. I think at least the initial first pullback, that area there, that key pivot, roughly at 1800, I think the actual low is like 1802 or something like that. I think that'll hold up, but we'll probably get a 3 to a 5% pullback, but not before we get, we could get, that final last gasp when a lot more people are chasing this thing and they just chase it right up, and then we just kind of run up here like that. And then you'll probably see big money selling into this, and then it'll come right back down, and that's our first test right there. That's that 2134, which it took us a long time to break, right? Once we broke it, we're in our second full week of staying above 2134. If that fails, then we're going to come down for a little bit of a ride. I think we'll test 2000, possibly go below that. Okay, but again, I think that is pretty good safe bet near term. We've got a lot of support and breadth in the markets. We've got, over 75% of the stocks now are over their 200 EMA in the S&P. We've got the similar number. Maybe a little bit less over their 50 EMA. So the 200 EMA, the percentage of stocks over their 200 EMA being as strong as it is, tends to show that the markets have got a lot of good firm support underneath them. I am still sticking to my forecast that sometime by Q1 2018, that's 16 months out, maybe a little bit longer, we're going to see a pullback of 25 to 35%. That's what I believe we're going to see. I don't know what the trigger is going to be. Let the TV talking heads figure that out. But our group, you guys will know well in advance. We'll watch the charts, and if we start taking out some key pivots, then we're going to adjust our strategies. Right now, our strategy is still to the upside. We take advantage of any pullback. We want to be able to jump in on that. Okay, so if we come back to the daily here, this is kind of where we're sitting. All right, if I put all of my indicators on the screen, you can see here, and if the blue line is where we open for the year, right? So if I come in here, some of these go down on 2-hour charts or smaller, but you can see the former all-time highs sitting here at 2134. You can see this tight range that we've been in. You can see the all-time high price here at 2172.50. For today, we went up to 2171.75. So we didn't really quite hit the all-time highs, but this is where we're sitting now. I think, and you can see this colored bar here. This shows you the timing on the bottom down here, the timing scale, and then on the price axis also the general price of what we can expect. And you can see it's kind of centered right there, but we can say anywhere from the lower end side of about 2185 all the way up to about 2220. All right, something like that. So that would be our range here that I would expect to hit in the coming weeks. You can see right here that first black bar from a timing standpoint was calling for August the 8th. So that would be, you know, towards the end of next week, getting into this zone here. Now notice it extends all the way over here to November the 15th or something like that. So it gives us a long extension, so we could run up and kind of meander, come down and test that. And if this holds, this would be an excellent place, the former all-time highs. If we come down and get a test and it holds, and then it starts moving up, that would be an area, a definite area where I would want to jump in long, because that means we'll probably work our way back, take out that high and come up into this area, and then figure out what we want to do, because that'll give us a final print in an Elliott Wave 5. Okay. So a lot of this, again, we're on this side of the chart. You never know what's going to happen. You base this side of the chart on action and probabilities on that side. So this is kind of where we're looking right now. I know I tell a lot of our members that we're still long, and they're just like, damn, man, will this thing ever stop? And I say, yes, it will. It will stop. But it always stops when you're not prepared for it to stop. Generally, when everybody, you know, capitulates and say, okay, I'm long, I start going long, then sure and shit, that's when the market rolls back over again. So this is what we're looking at on the S&P 500. Now, if we look at the Daddy Kingpin for the week, and we look at Nasdaq, let's look at the Nasdaq 100 futures. You can see here that we're way up into this area here. We're coming up to the 2016 high and the 2015 high. We're testing it right now. So we made new 2016 highs for today. You can see right here, this is not a valid area here. We're still in a 3-leg up. I mean, we've just blown right through, and now we're challenging the highs in 2015. Remember, the S&P 500 and the Dow have already taken out 2015 highs. The Nasdaq, we're just now catching up and challenging the 2015 highs, okay? Those other indexes are well over. So this suggests we can run up a little bit as well. So we're seeing some sector rotation in Nasdaq or technology companies, and in some healthcare. Keep in mind, healthcare, we're seeing some rotation there too, and traditionally healthcare is one of the last sectors to come on strong towards the tail end of a bull market. So this thing really kicked off March 6th, I think, in 2009, and we've just been, you know, Katie bar the door, let's start rocking and rolling to the upside. So that's kind of where we're sitting right now. Nasdaq had a really great week. Now, will it continue next week? Well, the odds do favor continued upward movement. We can get a little bit of a slight pullback. That would be normal. But right now, we're still a buy the dip kind of mentality. If we take out key pivot points to the low, that'll change, obviously. But right now, we are still a buy the dip mentality. Okay. Now, if we come over here and look at volatility, let's look at VIX here. The VIX closed at 1187. Okay. You can see I have different zones on this chart. Now, for our members, you know what that means. That's basically you'll see here these percentages. These are percentage of capital recommendations I make when you're in this zone here. Don't use more than 25% of your capital in credit spreads unless it's an isolated event, especially those that are doing iron condors and the Russell or the SPX, the cash index, or things like that. Now, you would do the volatility zones in the RUT, or in, let's say, the SPX. You could use the VIX here, that's fine. But you can see here that the low for the year, we're near the low for the year. If I raise it up, you can see the low for the year is 1140, and we're almost there. When we are down in this zone right here, the odds dramatically favor an up move. Okay, so just understand that. Typically, when you get to an Elliott Wave 5, towards the end of a bull market, or towards the end before you have a little bit more of a pullback, like 2 to 5%, and 5% may not sound like a lot of a pullback, you know, but if you take 5% on the S&P 500, you know, you're looking at over 100 points, okay? But generally, when you get towards an Elliott Wave 5 to the upside, you're going to find the volatility is in what I call zone 1, which means it's more than likely to move up to zone 2 than it is to stay in zone 1. Now, we can stay here for a while. We spent a lot of 2015 in zone 1. You can see right here in 2015, the markets were just, you know, happy to hang out here a lot until we got this huge move here, the biggest move percentage-wise in the VIX in the history of the markets, or at least in the history of running the volatility like this, and it moved up in 3 days, but it was dramatic. So what happens is you tend to get these pops to the upside when you get down here in zone 1. You do not see pops to the downside. So the risk of a big move is to the upside. So that is why we do not want to deploy more capital in credit spreads when we're down here, because the risk is just too great. You could get underwater really quick hanging it all out with a lot of credit spreads down here. So this is just a word of caution. Okay, the VIX is down very low. Even the futures, the September volatility futures or August volatility futures, very low. If we look at the bond market does not believe Yellen, doesn't believe anybody. You can see right here, let me put all the indicators back on the screen. You can see the bonds had this dip down when the Feds, you know, the odds started going up that the Feds could hike their rates in September. But it was really funny. There was a 30% chance, if you looked at the Fed fund futures on the CME website, there was a 30% chance of a rate hike before the FOMC. After the FOMC, some people were saying, well, it was a little bit more hawkish. They indicated that September could be a live meeting for potential rate hike. Yet the Fed fund futures reduced the probability of a rate hike in September down to 18%. So the markets don't believe the Feds. They're losing credibility very quick. You can see here how bonds just, you know, bonds don't start going up like that if they believe there's an interest rate hike coming. All right. They just don't do this. So again, there's just softness all around, and everybody likes mo money. You know, they like their mo money kind of thing, just like they like their it's like you like a free steak and a beer, right? So anyway, there's the 2016 high for bonds. The odds favor this to continue to just come up. Also, a big contributing factor, again, you got money coming in from Japan. You got money coming in from Europe. Europe is not looking good. They had the bank stress tests after markets closed today across Europe. The banks did not look very good. Italy is the one to watch. So let's keep our eyes on that for next week. All right. So this is kind of where we're sitting in the bond market. It's a risk-off asset. If we look at currencies, well, what do you think the dollar did? Went down big time. Look at that move here. It just fell off the table. Why? Because again, they do not believe Janet Yellen. I mean, it just fell off the table, which is, you know, a bummer for me because I'm heading over to Europe tomorrow, doing some seminars across Europe for the next 6 weeks, 7 weeks. I will still be running our sessions and doing our coaching and our morning pre-market sessions. Thank goodness for the internet and a nice PC. I use the Surface Pro 4, which is or 3, and it's great. I love it. So this is kind of where we're sitting for the US dollar. If we look at the euro, unfortunately, it just shot right up. I was loving the euro down here. I was hoping the euro would just continue on down. But with those recent data, the GDP numbers, they came in weaker than expected. So again, the markets love bad economic data because that means that just pushes the Feds out even further in time. Folks, we are addicted to this stuff. We're addicted to free money, loose stimulus. I can tell you, eventually this is going to change, and we're going to see bond markets going down hard. We're going to see equity markets going down hard because the PE ratios are going to be adjusted with all stocks when interest rates start going up. We're not there yet, but it will be. So let's just kind of see how this thing plays out. Meanwhile, with the British pound, I still believe the British pound is going to come down much lower. I think it's kind of hit an impasse here. August the 4th, next week. Towards the end of the week, we get Mark Carney in the Bank of England. He's probably going to come out and do more stimulus. You know, like that's what the global economy needs. Japan, China, all across the ECB, Britain, South Korea, they're all doing more stimulus. So Yellen doesn't have to do anything. She just sits back and lets all this money flow in here, keep our interest rates low, our bonds high, and it also weakens the dollar, so she can just sit back. But what's going to happen is it's all going to build up, and the music's going to stop playing, and there's only going to be 2 chairs for about 4 or 5 people to sit down in. So a lot of people are going to get their butts dirty. we're going to take advantage of it when it happens. So that's kind of where we're sitting here in the currency market. Gold, well, gold did what gold does. When you've got a little bit of fear and you see no signs of inflation and loose stimulus, it goes back up. We're going to head back up to the 216 area again, or 2016 highs. 1377, we hit it both in time and price. I think we're going to come up and challenge that again. So that's a little bit about gold. Silver's been outperforming gold, as I've told you guys many times. In my updates, I've been long silver all the way down here. So I'm just playing that to the upside, so that should be pretty good as well. So that's silver. Now, if we come over and take a look at oil, I told our members once oil broke the 41 handle, we went into an official bear market territory. Oil, when it gets down in these levels down here, becomes more correlated with the equity markets, meaning when oil falls, it's going to pull and drag the equity markets down. In fact, ExxonMobil and Chevron came out with their earnings this morning pre-market, and they really missed big time. And just Exxon alone was responsible for a negative 20 Dow points. These oil big mega cap companies and a lot of other oil companies can control the S&P and the Dow. They're just huge. It's a big part of the GDP number and earnings per share for the overall index. So if this thing starts going down lower, then we can expect the equities to follow suit. So you need to watch oil. You'll see the correlation start to move up the lower oil goes, okay? Now, we've got some other things going on in the agricultural market, some in meats. We're going to start looking at some soft opportunities as well as some of the soft commodities. But this is a little bit of a quick update for you guys for the weekend. Otherwise, have a great weekend. And I will see our members Tuesday morning, this next Tuesday morning, this Sunday night session. I'll be on a plane over the Atlantic, so I'll be unavailable at that point in time. But I will see you guys Tuesday morning for our pre-market session. And I should be in the chat room, our chat room again on Monday. Have a great weekend, everybody, and I will be in touch. See you later. Ciao.